Welcome to Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's take a look at what happened overnight. European equities fell, but investors on Wall Street, they were waiting on comments from Fed Reserve Chair Jerome Powell, the central bank chief, saying he sees two more cuts totaling 50 basis points this year as a baseline if the economy evolves as expected. So stocks initially fell after those comments. Bond yields rose, but then the stocks recovered after the major indices there finishing modestly higher. Sector-wise, energy posted the biggest gain, while materials and consumer discretionary stocks finished down. Well, the S&P 500 ended the month 2% higher, its best September since 2013, defying historical trends at this time of year, and is now up 4 quarters in a row. And for the quarter, the S&P rising 5.5%, the Nasdaq gaining more than 2.5%, and the Dow climbing more than 8%. Well, overnight, the mega cap tech stocks were mostly positive, with Apple leading the gains. US listed shares of Stellantis fell heavily, the owner of Chrysler, Jeep and Fiat warning about lower than expected profit in the face of stiff Chinese competition on EVs, and that saw Ford and General Motors also lose. Shares of parcel service providers FedEx and UPS gained as they're seen as benefiting from a strike at US ports. And shares of the gold miners tracked the price of bullion lower as it eased from its recent record high. Well, Federal Reserve Chair Jerome Powell has said he sees two more interest rate cuts totaling 50 basis points this year as a baseline if the economy performs as expected, he said. Though he went on to say the Fed could cut faster if needed. We will do what it takes in terms of the speed with which we move. Well, US Treasury yields rose across the board on those comments and suggestions that the central bank will take a gradual approach on cutting rates. The US 2-year rose to 3.67% and the 10-year rose to 3.8%. Markets are pricing a 100% chance that the Fed funds rate will be cut by 25 basis points at the next meeting in November, and a 35% chance of a 50 basis point move. Meanwhile, Australian 3-year government bond yields have risen to 3.48%, the 10 years at 4%. Markets pricing a 65% chance the RBA cash rate will be cut by December. And the US dollar has risen on perceptions of a more hawkish outlook from the Fed chair. The Aussie is at 69.2 US cents. Well, taking a look at commodities overnight, oil prices were a little changed despite signs that Israel, well, in fact, we've just had news that it has launched a ground incursion in southern Lebanon. Brent crude futures at $71 a barrel while posting a 17% loss for the third quarter. Base metals are mixed. Iron ore has surged more than 6.5% to $108 a tonne. And gold has fallen almost 1% to $2,634 an ounce, but rose 13% over the quarter, its best performance since 2020. Meanwhile, Goldman Sachs has raised its gold price forecast to $2,900 an ounce for early 2025. And Bitcoin, well, that's tumbled to below $63,500 US. Let's get across what is moving those markets at the moment, with a particular focus on what we're seeing on Wall Street. Steve Sosnick joins us from Interactive Brokers. Steve, welcome back. Good to see you. As we, of course, are just saying, rounding out the quarter there, what a quarter it has been. How would you describe? I guess, obviously, given at the end of it, we had that the rate cut, well expected, of course, but it is all about what comes next. Let's actually start at that point first. What you heard from Jerome Powell overnight, was that a bit of a surprise? Because seen as a little more hawkish than expected, perhaps.
Good morning, Andrew. No, it wasn't, I think, a big surprise. If you've been listening to him all along, this is really no different than what he's been saying. He's been saying that we don't expect more than 25 basis point cuts at the coming meetings, and this is what you're getting. But that's not what the market wants to hear. The market has really gotten used to sort of happy talk from the chairman, or at least basically a situation where they can take the chairman in a positive light, and they couldn't this time. And so, it wasn't long lasting. There was a little bit of a sell-off. There were some technical reasons with some options expirations. It's not an expiration day, but there's a big fund that had a huge S&P contract at 57.50. I think that pushed it up there. Also, remember the rally we saw more or less took place within the last 20 minutes of the day, which is when the market on closing balances come out. So it was clear that there was either portfolio marking or end of the quarter buying, but it was very much of a, the character of the day was very much blah all day. Then Powell spoke. Market wasn't really, the stock market didn't love it, the bond market didn't love it, but the stock market, because it's conditioned to move higher and bounce, then that's what it did.
And as mentioned there, rounding out the quarter positively, but interestingly, going in those historical trends with September. How do you see where the equity market is right now? Over there, here, everywhere. We're at record highs at the moment.
Yeah, I mean, this has been a quarter to remember in a sense, because basically, no matter what you looked at, it was up. There were very rare exceptions. Japan ended up lower for the quarter, but that was like snatching defeat from the jaws of victory, because last night, they were down. Last night, my time, yesterday, your time, they were down 4.8% and ended up closing out the quarter very slightly, by like 4.2%. So they were even looking a little bit higher. Some of the laggards, like France and England even closed a bit higher. And as you got, certainly the Chinese stimulus helped. It definitely, the Australian market definitely benefited from that too, although of course you were already benefiting from, prior to that. But that basically, was just sort of the cherry on top. Almost everything went up this quarter, probably because of the, perception of easier money. Oddly enough, one of the real laggards was U.S. mega cap tech, which tells us that rotation was really a key factor this quarter. The money, now rotation can indicate money flowing out of one thing and into another. It was just more that the money flowed somewhere else rather than where it had been flowing all along. Mega cap tech being the preferred place for so long. But actually now you have the S&P 500 outpacing the NASDAQ 100, which tells you a lot. And also the equal weighted calculation of the S&P 500 was up, far more than the capitalization weighted, which is heavy with big cap tech. So the equal weighted was up about 6% and change, and the other version, the outpacing the normal calculation of the SPX, which was up I think 3 or 4%. I don't have the numbers right in front of me, but so this was rotation. Let's find what's out of favor and buy it.
Indeed, and that's certainly been transpiring here. We've seen the rotation out of the bank stocks into materials. So, Steve, the question is what investors are likely to do as we enter the next quarter, of course, whether they do take some profits, bearing in mind also we're now back into earnings season, and goodness, just over a month to go until the election.
Well, let's not get ahead of ourselves. We're not at earnings season yet, but it's coming. Yeah, I mean, over the next, people say, what are the catalysts going forward? Well, we've got several, and I think that's interesting because on Friday we saw VIX really jump sort of out of nowhere, so almost as though people realize that there's these catalysts coming. Obviously, this week there's your general array of numbers, but the big one, of course, is Friday's jobs report. And then and of course, the question that leads to is, can the Fed really focus? What does the Fed need to do or want to do to ensure maximum employment? But then next week we get PPI and CPI. The PCE core deflator, which came out on Friday, was pretty benign. So, for a turn there, people could sort of think that they could focus strictly on employment, not on prices. Let's see if that's the case. And then, yes, a week from Friday, JP Morgan, which is sort of the unofficial kickoff to earnings season, reports, and then we get right back into it. And I think the question for earnings season that we all have to ask ourselves is, to me, this is going to be all about guidance. Because at this point, we know that companies beat their EPS estimates. It's always 75 to 80% of companies do that. So that's no longer a sufficient condition for a stock to rally. What's necessary is something else to be good, and generally that's got to be guidance. What we have here is we're pricing in roughly 10% or more earnings growth for the S&P 500 over the coming quarters. How are we going to reconcile that with an economy that's weak enough to require the sort of rate cuts that the market's pricing in? And that's going to be the key. And I think as equity investors, we should be rooting for the guidance, not so much for the rate cuts. But of course, what the rate cuts have shown us is doesn't really hurt. They don't really hurt either.
But on that basis, do you think the market's setting itself up for disappointment?
Quite possibly. When I look at an end of the day rally like we had today, where it was just pure markup, when I look at how we muddled along all week, you know, you have to ask yourself, is this as good as it gets? And is there going to be, fresh money continuing to come in? The argument would be if we keep cutting rates, if the world central banks keep cutting rates, which is, basically, you meant in your opening piece, you mentioned the Fed and the Australian central bank, and then you've got the ECB and everybody else. The only outlier there is Japan, and certainly China's cutting rates like crazy. So that's certainly an environment that should push money into riskier assets. But that's not a foregone conclusion. I guess the question becomes, do people want to keep pressing their bets, or do they want to take some money off after basically 2 years of phenomenal returns? So it's a little cloudy, and that's why I keep looking back toward the numbers, because you know what? If the Fed's going to be data dependent, so should we, except our set of data, of course, involves earnings and guidance, which that tends not to come into play for them.
Steve, great to get your outlook. Thanks for joining us from Interactive Brokers.
My pleasure as always.
Let's take a look at where we're likely to get going in just a couple of minutes' time on this Tuesday. As you can see, SPY futures are off around 0.4%. There'll be a particular focus on materials again. We have seen the copper and gold price come off overnight, so those producers will be in focus. But of course, we've also seen some outsized gains, particularly for iron ore, and as a result, those miners have made a good comeback over the past few sessions. All right, stay with us. The Open is just a couple of minutes away.